To summarize, despite several production and delivery issues, the model became the best-selling vehicle overall in Europe and the best-selling non-pickup vehicle in the US in Q1 of this year. The Tesla team deserves enormous praise for these outstanding performance. Hello, everyone. We're here to discuss one of the most talked about subjects in the stock market right now, Tesla's incredible first quarter profits. It's true that Tesla is on fire, and I'm not just talking about their electric cars either. The company recently released its first quarter 2023 earnings report, and the results are pretty interesting. In fact, they really show where our portfolio should go. So let's not wait any longer and jump right in. As everyone knows, the pandemic's after effects are still present in the economy, and Tesla isn't exempt from them. What's interesting is how the company is responding to this situation. It has been lowering the prices of its cars. The most intriguing finding for this quarter is Tesla's operating income and surprise. There are some unhappy numbers on the graph. China shutting down last year. Tesla's gross profit took a hit, falling from 5.5 billion in the first quarter of last year to 4.5 billion this year. This is a year-over-year reduction in gross profit that we haven't seen in a long time. Tesla actually saw growth, but this year's price drops are really having an effect on their profitability. According to earnings reports, they made a whopping 2.7 billion in operating income, which is slightly less than quarter 12, 2022, and the lowest in a while. You might be wondering, if this is less than before, why are we so excited? Well, let me tell you that it all comes down to Tesla's gross profit and profitability going forward. After all, the company's current valuation is based on the fact that it is a massive growth company. If Tesla is able to consistently generate 5 billion in earnings per quarter, that's 20 billion in earnings for the year, and a 25 times price to EBIT ratio that justifies a 500 billion valuation. However, here's the thing. America is going to be a bit more difficult this year, and that's where Tesla's Score 1 earnings report comes in. While the operating income might be a bit lower than before, their gross profit and profitability are still pretty solid. And that's really important because it means Tesla is still growing and expanding, even if they may not hit that 20 billion mark this year. Plus, let's not forget that Tesla is consistently innovating and introducing new products, which only adds to its potential growth and profitability. Now, Tesla's revenue for quarter one was $23 billion, which is insane. But what's even more impressive is that their operating income was a whopping 19.3%. That's the lowest it's been in 4 quarters. To keep in mind, that doesn't even factor in all the price declines that occurred in quarter 2. So we might see these numbers drop even further. But here's where things get interesting. While Tesla's model allows them to profit from every incremental $1,000 for FSD, they only make around $5,000 to $15,000 on a car. So even a decrease of $1,000 to $3,000 can have a huge impact on their margins, which then affects their income statement. It's like a never-ending cycle of financial jargon. All right, but here's what I find really fascinating. It's like we're watching a real-time economic case study unfold right in front of us. At first, I thought Tesla would easily shrug off these price cuts and earnings, would remain flat for a bit, but now I'm starting to think earnings might actually start to decline looking at Tesla's operational income annually. They made an astounding $12.6 billion last year, but it's uncertain if they'll be able to surpass a $20 billion mark, given that the company's first quarter results put them at a lower run rate. Here's where it really gets personal for us investors, Mark. While we all have faith in the company and its ability to innovate, it becomes for Tesla's $1 trillion or $500 billion market cap. Still, let's set all those numbers aside for a moment. Looking at last year's numbers, you can see that Tesla's energy business hit a record-breaking revenue of $1.3 billion. However, this year outdid themselves and soared, bringing in a whopping $1.5 billion. How did they manage to achieve this? Well, thanks to the phenomenal growth of their Megapack business, they have been deploying batteries like crazy, reaching 3.9 gigawatt hours. And they recently opened a new mega factory in Shanghai, which will only accelerate that growth. Now, I know that some of you are worried about the recent price cuts and how they will affect earnings, but as shareholders, we're in this for the long haul. So it's definitely something to watch out for. While deliveries of Tesla's quarter one earning for might be looking a little soft, but let's not forget, that they are the most profitable and strongest company in this space, and that spells bad news for competitors like Rivian. And lucid sorry, but not so sorry, right? Hey, but hey, Tesla has plenty of cash to get that through this. They're going to be fine in the long run. However, it is interesting to note that during this recession, earnings could go down or flatline for a little bit, impacting such a strong growth story. But let's not focus on the negative, because there are so many positives to talk about. Tesla's energy business is booming and its mega pack business is leading the way. And let's not forget about their amazing electric cars, which are changing the game in the auto industry with every passing day. More and more people are switching to electric cars, and Tesla is at the forefront of that revolution. Now, if all of that doesn't satisfy you, then you got to take a look at what Musk is going to bring out in the next few months. Yes, with the news of Tesla planning to bring out a far affordable program. I think the charts might shoot. Madly, this is the platform that's going to be used to create the much awaited 25.0 Tesla. Yes, you heard correctly. Elon Musk stated during the third quarter of Tesla's earnings call in October 2022 that the next generation platform would only cost half as much to produce as the current Model 3 platform. Given how successful the previous models have been, just think of what Tesla can accomplish with the even more affordable platform. Now, let me be clear, that does not imply that the new platform will be exactly half as expensive as the Model 3 or Y. Rather, it does mean that the price will be significantly lower, making it more affordable for a wider range for people. Let's face it, who wouldn't want a Tesla at a lower price point? However, it's not just about the price. Regarding production volume, the next generation platform will also mark a significant advancement for Tesla. Coming back to what we have now, Elon Musk has stated that the production volumes for this platform will surpass even the Model 3 and I, which is an incredible feat in and of itself. This means that we can anticipate seeing more Tesla vehicles on the road, and hopefully reduction in wait times. As we all know, this is great news for our shareholders. I understand that some of you may be concerned that Tesla's valuation may drop to more affordable heights. Crack up. Though there's no denying that there is some economic uncertainty out there, and that can have an impact on the stock market. Investors should not worry. Even with the bearish technical pattern, Tesla is still a stock that investors should keep an eye on. In fact, at lower levels, Tesla is actually a much better investment. So if you're thinking of investing in Tesla, don't forget that it's still a massive earnings count. And with such strong sales, there's still plenty of room for growth. However, as we previously stated, we can't give Tesla a 10 out of 10. Instead, we must acknowledge that the company is starting to see a slow in growth, but the first quarter saw EV's gross profit margin fall below 20%, the lowest level since the end of 2020 as a result of significant markdowns. What does Tesla's most recent earnings report teach us then? Basically, it tells us that continuing to lower car pricing results in lost margins.